There is no chance of reversing inflation. It's far too late. So what does that mean for you? You came here for the truth. Many people are struggling today, and you can see exactly why. The prices of everything are skyrocketing, and yet their wages do not keep up. I'm going to cover all of that. The first thing I want to look at is the trap, what the Federal Reserve has trapped themselves into. The second thing is the catch-22. Directly in line with this, we're going to look at how if the government and the Federal Reserve do one thing, well, then they're going to be stuck doing this other. The third thing I want to talk about is how certain aspects are upside down right now. We could see that all over the place, along with your wages and everything focused around you. Let's begin. Take a look at this Bloomberg article right here. Massive US debts could trap Powell as Fed fights inflation. Of course, all of this information being contrived, but this is what we have to go on. Aggressive Fed hikes may risk market volatility and credit crunch. So what they're saying right now, quite simply, is that inflation is rising. They will have to act accordingly, meaning that they'll have to raise rates faster than originally anticipated. Debt overhang could also limit how high the Fed can raise rates. When you've got excessive debt, you can't necessarily push that too far because it's going to break the backs of not only the national debt, personal debt. What about corporate debt? We'll talk more about that in a second. The US went on a borrowing binge last year, and the hangover could make it harder for the Fed to fight inflation without crashing the economy. It's impossible, by the way, to ever actually stop it without crashing it. But anyway, corporate debt has surged $1.3 trillion since the start of 2020 as borrowers took advantage of the emergency Fed action, slashing interest rates and backstopping financial markets to keep the credit flowing. More debt held by more companies suggest potential risks are borrowing costs as borrowing costs rise from currently low levels. Of course, they're borrowing at 0%, and suddenly that's anything higher than zero. It's going to be a heavy burden. We know that. This could create financial stability concerns for the Fed and its colleagues as they debate removing support in the face of what Friday's report on Friday showed will be the hottest price increase in 40 years, inflation off the charts. And so we have this to think about. What is the Federal Reserve going to do? They have already started to dial back the amount of money that they print per month. And in the coming days, we're going to find out if they take that even further. So I will cover that, of course, on the channel. If you are, I noticed some comments were suggesting, they're not doing this, they are not cutting back. All you need to do, quite frankly, is go to a search engine and type in Fed H41, and you will get the data for yourself. It's all listed there, how much that they have been accumulating over the last while. It gives you week by week numbers. So it's all up to you if you want to check it out. There are negative aspects when you encourage people to borrow, but then later feel that you can't raise rates because so many people borrow. That's something of a trap. To be sure, big firms that use the opportunity to issue longer dated bonds at lower rates have strengthened their balance sheets. I'm sure they have. Record refinancing need, amount of corporate debt maturing within 5 years is at an all-time high. You can look at the investment grade debt. Yes, it has increased over this last decade, but we have also seen the junk loans and junk bonds increase as well. That's what this shows you right here. And then we have this. US debt spikes, federal government, households, and businesses increase their borrowings. Why? Because the debt is cheap. And they've done so at a rate we've never seen before. And the corporate buybacks are also here. That's right, taking advantage, no doubt about it. Fed hike seen starting with yield curve flattest in a generation. This is, of course, sending a little bit of a shockwave through the bond market. Not the first time we've seen this before, but it usually is a big signal. High inflation is pushing the Fed to move faster toward tightening. Flattening the curve is already ringing the alarm bells for investors. So you can look at this if you are interested. I can't get into all of it, of course, but just showing you the chart. Market sees the Fed hiking sharply, but not getting rates very high in the cycle. And of course, they can't. I have always said that I personally believe that they will not be able to get to I think it's going to be somewhere between 0.75 and 1% before it actually creates and induces a crisis. Who knows what that number will be, okay? There is so much more in this article related to this message, but remember what happened, 2018. 2018 was a very big year. In fact, in my opinion, the biggest and most important year that we have seen since 2008. Why? Because we found out specifically that the Federal Reserve and other central banks around the world start to reduce the amount of money that they printed, or they actually reduced their balance sheets. And during this period of time, along with increasing interest rates, the whole world was essentially going into a tightening cycle. Why? Because in 2017, month after month after month after month, asset prices were rising, economy was doing well globally, and we know that. And so you have this period of time in which, hey, everything's good. Okay, we're going to start to look at tightening up. And the whole world did this. And 93% of assets fell that year. 93% of assets. So it's basically across the board. So we know that that's the history behind it. And of course, should they decide to do this again, it may have the exact same effect, except you've got more debt. You've got a bigger balance sheet. You've got worse conditions in many different ways than we had in 2018. 2018 was pretty good compared to 2021, I should say. And you look at all of that data and it just adds up. But anyway, there's more in here. Let's look at this though. We have been talking about lumber all along. The price went from, let's say a historic normal level all the way up to 1,700 approximately, and had fallen to approximately 450. So that dramatic rise and fall was unbelievable. And I've been covering this all along. When it dropped down significantly, I had told you oversold based on the technical levels. And if all other commodities are rising, it would likely go along with it. Here we are, lumber sourced to a 6-month high as buyers scurry to find wood. There's a lot of speculation. You could talk about the supply chain problems and so on. Yes, that is a factor. But behind all of this, the fact that it went from historic norms to 1,700 and then went completely down to 450 was not because of supply chain issues. It's because of the speculation. Just take a look here. Look at this. This is the chart for lumber. And essentially what we are seeing here, by the way, it plays very, very well with the technicals, if you're interested in that. But anyway, looking at this, it has been, just from October, it declined down and into November, and has since November 2nd, it has been rocketing, absolutely rocketing higher, doubling nearly in this period of time. Just look at that. And it's following the technicals nearly perfectly right now. So we know that this is because the reason I mentioned that is when you look at this information, and why I keep harping on why I want to talk more about this, and I'm glad many of you have mentioned it. I will look at that. That's not, it hit the bottom Bollinger Band on the stock RSI is oversold, and it starts to come up significantly. Okay? Depending how you want to enter this, you look at this. This is just, by the way, showing us on different, doesn't matter. What I'm looking at here is look at the left chart. That's all that's important right now. If you want more in depth, I can always do that on multiple time frames. This was just something just to pull up one chart. But anyway, the point is that this is speculation. That's all I'm trying to get at. Okay, that's all. Dip. Buyers scoring historic win in stocks that defy the bond warning. S&P 500 had its best week in 10 months, and showing us that hedge funds returns as buyers. Hedge funds return as buyers while equity inflows continue. Pardon the mumbling. This is just showing us right here. By the dip, S&P 500 had an unusually high tendency to rise after a big down day. Looking at that, in this period of time, 2021, historic amount of stocks going up. I shouldn't say that. I should say the broad market going up, because actually you look and it's not looking very healthy, especially in the NASDAQ. But what we're having here is, of course, more and more gains, despite the inflation that affects you. your wages, affecting you. All these problems that affect you directly. We have the stock market rising considerably. And look at this. So key to understand. My friends, I've got friends in Norway and Finland and Sweden and Denmark and Germany, all name a country. I know that you're out there. Okay. And I am always actively looking for the information for you. I'm trying my best. Okay. Look at this. 20 central banks hold meetings as inflation forces split. Fed is expected to taper support while others are still easing. It depends on where you look, actually, because as I have noted previously, there have been dozens and dozens and dozens of interest rate hikes. Just depends on where you look. Bank of England's hiking hints undermined by what's happening today. The differences are going to be on display this week with final decisions for 2021 from the Fed, the ECB, the Bank of Japan, the Bank of England, together responsible for monetary policy in almost half of the world's economy. We've got 16 counterparts coming on as well. So this is a huge week as far as central banks go. So by the time we get to the end of the week, of course, I'm going to give you updates all throughout the week. We will see, are they also going to tighten? This may be a repeat of 2018. If you stayed here for this part of the video, flash those warning signs. Are we heading back into 2018, but even worse? Okay, just looking at this, the central banks are saying one thing, their actions certainly over this last while have said another thing, but their balance sheets are really, really key to look at. The Fed, ECB, the BOJ, all expanding to a degree we've never seen before in history. And all along, easy money, corporate buybacks, profits like you've never seen before. What are companies doing? Well, they are increasing their prices. Why? Because they're saying the input costs are higher. We're going to increase prices. And you also have conditions in many places, companies, this happens to be Kellogg's, saying, we don't want to work here under these conditions. We want more pay. We want this and that. So in this particular situation, Kellogg's, they're saying, we are disappointed that the tentative agreement for a master contract over our 4 U.S. cereal plants was not ratified by our employees. As a result of that, take a look. We have made every effort to reach a fair agreement, including making 6 offers to the union throughout negotiations, all of which include wage and benefit increases for every employee. It appears the union created unrealistic expectations. The prolonged work stoppage left us no choice but to hire permanent replacement employees in positions vacated by striking workers. You strike, you're fired. That's the way it goes. And eventually you will not be replaced by employees that are human. It will be robots. That is the goal. All of these people, even the replacements, will be replaced by robots. I assure you. These companies care about one factor, and that is corporate profits. Now that's not just Kellogg's. Okay, I'm not looking at Kellogg's specifically. I'm simply highlighting what companies care about. It's corporate profits. What do you think? What do you think they're talking about all the time in their meetings? Are they concerned about the consumer, or are they concerned about corporate profits, the shareholder? Put it in the comments below. Okay, look at this. Inflation is outpacing wage growth. Not that you needed a chart to see this, but taking a look at the CPI inflation, fake inflation, comparing that with year-over-year average hourly earnings, which is not a good statistic, of course, because most people are not going to feel the benefits of the wage increases. Still doing this. I mean, his wage growth is negative right now, minus 2.1% when you look at the two like that. What about this? If you went back, this is Northman Trader, if you went back in time to any period and told people that in 2021, with the lowest claims in 50 years, record job openings, 8% GDP growth, and 6.7% CPI, all good stuff, right? The Fed is not only still running QE and zero rates, but it's refusing to raise rates. You get locked up in the loony bin. How true is that? The economy is supposedly roaring, and yet you've got the easiest monetary policy in history? Something doesn't add up. And what are the insiders doing? I mean, look at this. Total value of stock sales by company insiders by month, a historic high. Historic high. Never seen anything like this before. Look at that. Stock sales by S&P 500 corporate insiders, a record high today. And if you stay to the end, you get something really cool, okay? This right here just shows us our reserve currencies changing over the 120 years. This is a video and you will see it. I'll just try to hit play. I hope that will come through for you. Essentially what we're looking at here is how this changes. Now, if you want, link in the description to check it out. But it's going from the early 1900s up until the present day. And you see after the 40s, certainly the US dollar's role changes big time. Wasn't always like that. It was not always like that. And you see it growing over time. And then suddenly the euro comes online and takes a big market share. But you had the pound sterling start to disappear over the years. Does it mean it's gone completely? No. Like any of these other ones, the French franc, all these other currencies, right? For a period of time, they look strong. And that's just the way it is. Things change over time, okay? Nothing lasts forever. Not a currency, not an empire. And of course, if you look at it at a deeper level, in my opinion, this is all done on purpose. But we're not allowed to talk about that. So I'm going to end it there. Do you appreciate this information? Simply hit that thumbs up button. That's all I ask of you to support the channel. Okay, just hit that thumbs up. It's right down there. And if you haven't seen this video yet, you definitely want to check it out. So just click it right here and I'll see you over there.